Fed solved the problem, FDIC rose to the occasion, crisis is over. That's completely false. That is what everyone's saying. That is how the stock market's reacting. This banking crisis is far from over. All the dominoes never fall at once. They fall sequentially, and sometimes there are time gaps between them, and everyone says, oh, all good. It's not all good. You have to look behind the curtain of the international monetary system, understand what's actually going on. These failures are symptoms more so than the real problem. The real problem has to do with tight money. And, interest rates are 5%. They're going to be, 5.25% soon. At least that's the target rate for Fed funds that the Fed sets. But that is a year or just over a year ago, March 2022, they were zero. So you go from 0 to 5.25% in about 1 year. That's extraordinary. I mean, people remember Paul Volcker raised interest rates to 20%, and he did, but that played out over a couple of years. This is 5% in 1 year, and the Fed's not done. I mean, they're saying, we're going to think about it. We want to look at more data, but they have not said we're done. This whole pivot narrative has been wrong for a year, and it's wrong now. So we have tight money. We have underwater bonds. We have bank management who don't know the first thing about risk management. If you knew anything about risk management, once the Fed said, hey, we're going to raise rates until we kill inflation. And that is what they said. Jay Powell gave 8 speeches between the summer of 2022 and recently, and he said that every single time. Well, if you're a bank risk manager and you hear that, you're like, I got bonds. Interest rates go up, bond prices go down. I understand they're unrealized losses unless I sell them if they're in what's called a hold to maturity account, but they're still losses, and it still destroys confidence. And now bank runs today, you don't have to line up around the corner in the rain, with your hat on, waiting to see the teller. You can just do it with your iPhone, and to the tune of, you can move $1 billion with your iPhone if you with the right accounts and passwords and all that. And so that's what happens. So the bank runs are instantaneous, and they're far from over. So yes, a little, kind of in a quiet period, but there'll be more. And a good analog, Matt, is the 2008 financial crisis. Everyone remembers, September 15th, 2008, midnight on a Sunday, Lehman Brothers files for bankruptcy. And that's true, but that started in the spring of 2007. When HSBC reported disappointing earnings based on mortgage losses, and then came to a head in August. 2 Bear Stearns hedge funds failed. There were high yield mortgage funds. At the end of July, August, the Fed raised the discount rate. It took a full year, another 13 months, to get to Lehman Brothers. And what happened along the way? Bear Stearns in March 2008. Fannie Mae went bankrupt in June 2008. Congress bailed out the system in August 2008, and then Lehman Brothers. So that took a year and a half, and there are a lot of crises like that. So we're in falling dominoes. It's not over. It'll get a lot worse, and people should prepare for that. But as usual, they don't. People are very complacent. Wall Street says it's all good, and people believe it, but they shouldn't. They're just going to go one by one by one, and it'll, with the risk that somebody decides to draw a line in the sand, and that's a mistake, or 2 or 3 happen at the same time. The panic becomes more generalized, and then we haven't even talked about the international banks, Deutsche Bank or UBS or UniCredit or Santander, Barclays, all the big, again, European, UK banks. So you're right. It's far from over. The next victim is being teed up right now as we speak. And Wall Street just keeps going. It's one thing when the markets are bad and you're kind of caught in the crossfire. It's another thing when the market systematically trades against you. Something like 2008, but worse, just a generalized global financial crisis where everybody's getting the money out of every bank, either buying treasury bills. Treasury bills at a brokerage firm are pretty safe because it's not about the brokerage firm. Brokerage firms fail all the time, but they have to segregate house fund, proprietary funds, and customer funds. Customer funds have to be strictly segregated. That's why John Corzine was pariah, because he co-mingled them in a global situation about 10 years ago. But they are kept as segregated accounts. That is audited and enforced. And so when a brokerage firm fails, they just take your account, all the accounts, and they just move them over intact to a solvent broker, and then life goes on. So nothing's risk-free, and there have been exceptions, but generally Treasury bills in a segregated funds in a brokerage account are safe because they'll just be moved. Either the broker will be fine, or they'll be moved over to another broker. Money market funds, same thing, in the sense that in 2008, the government proved that they're willing to bail out money market funds. And they did, guaranteed every money market fund in the country. So the best safe haven is gold. I say physical gold, bullion, coins or bars, and silver. It's not digital. You can't hack it, you can't steal it, and you can't freeze it. They just put it in a safe place. So, but Americans don't really get gold. They don't really understand it. So, yeah, I think it's just going to be a question of frog hopping from lily pad to lily pad looking for a safe place. The other scenario is that the government just throws in the towel and says, okay, all deposits are guaranteed in unlimited amounts. And I knew people who were trying to get $8 billion out of Silicon Valley Bank on that. They sent the wire instructions on Thursday night. One guy I talked to said, hey, Jim, from Thursday night to Sunday, we didn't know where the money was. We sent the wire instructions. We were trying to get it out, but we didn't know what the outcome was going to be, whether it was short or not, wire sent or not. And then Sunday night, the Fed and the FDIC came out and said, all good, we're going to, business as usual, open Monday, and it's all good. And he said the money went through. But that was what, people were facing, and they'll continue to face. The banks you mentioned, I don't know what their deposit flows are right now, but my guess is they're shrinking fast. People are getting their money out. And so you might just have to give a generalized blanket deposit insurance protection, and that would stop bank runs in theory. But then now you basically nationalize the U.S. banking system. You look like Argentina. So there are no, I guess the way to put it, Matt, there are no good outcomes. Either there's a catastrophe worse than 2008 that starts to look like 1931, 32, or the government offers so much protection that they've de facto nationalized the banking system. One just quick note I would add, I think when it comes to banking crisis, I'm a little bit of a magnet for trouble. I remember the Herstatt Bank collapse in 1974. That was a foreign exchange crisis. But through the early 80s with the Latin American debt crisis, and the late 80s with the S&L crisis, and then 1994, the Mexican tequila crisis with the collapse of the peso, 1998, long-term capital, .com, 2007, 2008, we talked about that. And today, October 19th, 1987, the stock market fell 22% in one day. Not a year, but in one day. So I've been on the front lines of all of those. But the one thing I've noticed is that each crisis gets bigger than the one before. And each bailout is bigger than the one before. And the question I'm asking as an analyst is, are we at the point where the crises are so big, it's bigger than the Fed? In other words, we're not really talking about bailing out a bank or a sector. People lose confidence in the dollar itself. And we do seem to be heading in that direction. By the way, I'm a big believer in diversification. You don't put all of your assets into any one asset class. I don't care what it is. But I'd have a significant slice of gold. Look, it's volatile. It's been up and down, and people get frustrated. Why isn't it at $5,000, $10,000 an ounce? It'll get there, but it'll get there very quickly. There's a basic piece of math, which is a fixed dollar increase becomes a smaller percentage increase the higher the value gets. So, for example, if you go from $2,000 an ounce to $3,000 an ounce, that's a 50% increase. But if you go from $9,000 an ounce to $10,000 an ounce, that's only an 11% increase. And it's the same $1,000, you still made money, but it gets easier. So that's why when these things do take off, $3,000, $4,000, it could go to $10,000 very quickly, because each increment is a smaller percentage and therefore an easier hurdle to clear, even though you still make the same $1,000 an ounce. So, so what I advise people is, hey, what are you waiting for? Why don't you get the gold now while it's reasonably priced and available? The time may come when the price is to the moon. But worse than that, you won't be able to get it. You won't be able to get it at any price, at least not physical gold. Call a dealer. I have gold dealers. I call them now and they say, well, Jim, I'll work the order and get back to you, but it might take a week or so. The Mint's not taking new orders. There's we're talking about the physical world. I'm not talking about ETFs, gold futures, and all the paper gold. I'm talking about physical gold and silver. There are shortages. So I would get it now while you still can.